Thanks everybody for taking the time to carve out a chunk of your day and learn about sales tax. What I'd like to do is I'll just go ahead and jump right in. Kristen already covered this intro on me, so we'll just skip right past that. And so here's a quick agenda of the things that we'll be covering today. So we'll do a recap of trends from 2021 that we saw, the impact of supply chain and labor shortages on tax compliance, some of the things that companies need to think about as a result of those things. Tax considerations for 2022, and what tax compliance automation looks like. And then, as Kristen mentioned, we'll have Q&A. If you feel like your question's if I'm in the middle of a slide and you feel like you've got a question that's very timely, please don't be shy about jumping in there and putting it out. I'm happy to stop the presentation and answer a question, because it might be a question that's on more mind than just yours. So jumping in, just kind of taking a look at 2021. It was, 2021 is the year following the initial outbreak of the pandemic and all the business shutdowns that resulted. And by and large, with the statistics on the screen, what you'll see is in 2021 a return to customers kind of buying again, right? Business returning in a way, but it's changed in a lot of ways. So a lot of sales started returning to storefronts. So you'll see in the second slide there is the in-store physical store sales return. So people started buying there again, which some of you may have seen a downtick in e-commerce. But as a result of the pandemic, a lot of businesses started making an effort to employ e-commerce, right? Because they couldn't count on the stores quite the same way they could before, and they couldn't quite count on some of their sales the way they could before. So a lot of businesses have been taking that into their own hands and finding ways to expand their market share through their own direct consumer efforts. And then I think the most interesting bullet on this slide for me was the last one, where it says 96% of mid-sized companies have changed as a result of COVID-19. That's a pretty broad statement, but it says, it's anything from shifting what you're selling, how you're selling, and then, automating your business in different ways. And a lot of companies having a more open mind towards remote employees, and maybe not even because you want to do it as much as because the market kind of demands it anymore. And all those things have an impact on your tax footprint and what you need to be considering when you are building out and maintaining your tax strategy. So supply chain, I'm preaching to the choir here, right? Everybody has felt the pinch in some way, whether it's specifically in your business or just when you've gone out, if you've tried to buy a car, or I have a personal story. I ride mountain bikes, and in 2021, I decided I'd like to get a new mountain bike. And when I last bought a mountain bike, I went to a store and they had a whole bunch of them in stock, and I picked out the one I liked and I took it home. And this time I went and found out nobody had any bikes in stock, and the prices were going up on an almost monthly basis. So you had to get your order in so that it didn't get more expensive by the time you got it. And then I had to wait, 3 months for it to come in. And when it did finally come in, they called, they said, hey, good news and bad news. Good news, your bike's here. Bad news is the handlebar stem didn't ship with it. We don't have a handlebar stem from the factory. So for those unfamiliar with the way bikes are built, a handlebar stem is what connects the handlebars to the head tube of the frame. So pretty pivotal part of a bicycle. If you don't have a handlebar stem, your handlebars don't connect, you can't steer it, it's not going to work. Obviously, we were able to get that squared away, but what they had to do is they had to sell me an aftermarket, different handlebar stem that would do the job. The point of the story is that the things that we used to always be able to count on weren't always reliable anymore. And businesses have to start pivoting, whether it's the manufacturer pivoting to a new supplier of handlebar stems in order to fulfill their orders, thereby creating a new business relationship with all the headaches that go along with that, to a retailer having to pivot at the last moment and sell a different product to the customer and figure out how to absorb the cost of the wrong handlebar stem and the whole equation. So it just creates a lot of trickle down effects throughout the whole process. So as a manufacturer or a distribution company, you might be looking at, if we want to fulfill our orders at the same rate, we want to provide a good customer experience, how much do we have to pivot in order to fulfill those orders? And creating new suppliers, creating drop shipping, things of those nature. So it makes new complication that didn't necessarily exist, at least not at the same level in the past. So some of the things about remote selling. By remote selling, what I mean, a lot of people think that I mean e-commerce only, and that's not what I mean. What I mean by remote selling is I mean that you're shipping product to another location. And I'm going to go ahead and just click these slides open so you guys can see them. So there's a lot of things you have to think about as you start selling remotely, whether you're shipping products through e-commerce or whether you are just shipping products like you generally would. There are new laws, which we'll jump into on the next slide. But nexus is the first thing that you need to consider. Nexus is a accounting term. What it actually means is a connection between two things. So effectively, nexus is your obligation to register your business to file with a given state or jurisdiction. So if your business is located in Texas and you have a factory there, or you have a distribution center there, and you have your employees there, then you have an obligation to register in the state of Texas and collect taxes on behalf of the state of Texas and remit them to the state. And then if you open up additional locations, other places, or if you put employees in different places, then you can create nexus in those locations as well. The next thing you have to be concerned with is exemption certificates, right? So if you're selling to companies that are not for, that are going to resell your product, or less common, it would be for municipalities and schools and charities, things of that nature. But by and large, exemption certificates come in the form of you're selling your product to somebody else who's going to resell that product. That's a crucial part of the sales tax compliance process, and it's one that a lot of companies get wrong. Taxability refers to the specific products. We'll dig in a little deeper on these in a moment, but what specific products are taxable, which aren't. Quickest analogy I can give you, and I overuse this, but it's just an easy one. If you go to the grocery store and you pick up a bottle of bleach and a loaf of bread and you put them in a cart, one of those is going to get taxed and one of them probably isn't. And that's what it means by taxability. And then obviously you want to provide a good customer experience, right? So you want to make sure that when you collect tax, you're collecting it correctly the first time, that you're not having to credit it back later, whether you're not going to have to, God forbid, have to charge it later. The point is you want to make sure that you get it accurately the first time so that your customer has a positive experience. So as we jump into this rule, this slide here is talking about a ruling in regards to Nexus that happened in 2018. So, and I think an error that a lot of companies that we encounter still face is they think that it applies to e-commerce sales only. So the reason I'm talking about it to you today is that it doesn't refer only to e-commerce sales. But in 2018, there was a Supreme Court ruling of South Dakota versus Wayfair. South Dakota sued this company Wayfair, which you may be familiar with. Wayfair is a very large furniture and home goods retailer, 100% online. They don't have physical stores. They have warehouses, obviously, but they're 100% online. So they were shipping an awful lot of product into South Dakota. And as the part of that process, South Dakota started feeling this pinch of, hey, we need to get more sales tax revenue from our state. And we're realizing big companies like Wayfair are shipping into our state. And there's a double impact here. Not only do we not collect the tax because these products are being shipped into our state, but we also aren't collecting the tax where it might otherwise go to our local retailers that would charge tax, right? So they're competing with the local furniture stores. Those furniture stores are not getting the sale because it's going to Wayfair because they're cheaper. And the reason Wayfair can be cheaper is because they don't charge tax. So this is happening, at this point in time all over the country in all kinds of different ways, but this is where it came to a head. And the Supreme Court ruled that, in fact, they sided with South Dakota and said, correct, we agree with you. These businesses that are selling a lot of business into your state should have to collect tax just as though they existed in your state physically. So the original ruling was $100,000 or 200 unique transactions would create economic nexus. And that term means that you created nexus because of the economic activity, not because of your physical location there. What's very interesting about that is over the course of the next couple of years, and you can see by looking at the slide, all the states rolled out economic nexus laws. The only states that are grayed out, you can see Oregon, Montana, Delaware, and Rhode Island. Those states don't have sales tax, so it doesn't really matter. Alaska is also on the list. They're actually they don't have a state sales tax, but they do have local taxes, and those local taxes do have economic nexus requirements. But what's also unique is that they started changing them all, right? So they didn't all follow South Dakota's idea of 100,000 or 200 transactions. Some just said $100,000. California, where I live, $500,000. Doesn't matter how many transactions, but the point is that they're all different. So as a business owner, you need to understand where you have created economic nexus, and you need to understand how all the states are different and what levels you hit in each one of those states. So it's very complicated. That's kind of the crazy thing about the sales tax world in our country, is that we have these 50 unique kingdoms that get to make up their own rules. And as a result, as business operators, we have to make sure we're compliant with all those rules. So it can get very complicated. So another thing that we've seen a lot of businesses do over the last couple of years especially, but it's been a trend for a while now, is employing companies like Amazon, Etsy, Walmart, et cetera, for what are called marketplaces, right? So if you manufacture a product, you might elect to sell that product through Amazon, and Amazon puts the product in the warehouse, it goes up on the Amazon website, and when people buy things, Amazon ships it on your behalf. That creates some unique tax compliance ruling or liability because when you put your product in a state, you now create physical nexus in that state. So it creates a lot of exposure for businesses because they don't think about it in those terms, right? I'm sending my product to Amazon and then I'm going to sell through Amazon, so no problem. But Amazon typically will scatter that product throughout their different distribution centers so that they can ship in 2 days like they try to promise everybody that they'll do. So if you're doing that, if you're working within Fulfillment by Amazon or any of those other types of marketplaces, I would encourage you to explore what kind of liability that's creating for your business. So when we look at exempt sales in general, many companies that we talk to will think, okay, but my sales are all exempt. So do I really need to register and file? And the answer is actually yes. So I kind of have these slides, I think a little out of order, I apologize. There's a slide I'll show you in just a moment that has the states where exempt sales are calculated as part of the economic nexus requirement. So what that means is if you, again, you have your business that's in Texas and you're shipping into 20 other states, right? And they're all exempt sales 100% of the time. Some of those states are going to require that you still register as an exempt, as a seller into their state, and file a return showing all of your sales, that they were all sold as exempt, and then the amount you owe is zero. It seems kind of crazy to have to file a return saying you don't owe them any money, but I think the idea behind it is that they want to make sure that it should be zero. Exemption certificates allow you to not collect tax so long as the exemption certificate is accurate for the customer that's buying it and for the products that they're supposed to buy, and that they haven't expired. Most don't expire very often, but some do. Florida, for example, I believe is annually. So, and I've kind of covered this, but just the challenge with exemption certificates in general is that they are typically not automated in any way. We talk to many companies that are keeping these in file drawers and banker's boxes. Maybe they have a document management system, some kind of a electronic. We scan them to the computer and that's where we save them. But employees often are not trained to validate them correctly. And it's probably one of the most common places for an auditor to start. When they come to a business that sells a lot of exempt business, they will look at the exemption certificates first because it's pretty easy to find errors. And think about it in terms of if you're charging sales tax on a sale and it should be 7% and you're only charging 6%, the auditor is going to say, hey, you're off by 1%, so we're going to get a little bit of that. If you should be charging 7% and you're charging 0, that's much more, right? So it's a much bigger exposure. And then what they'll typically do is they'll use what they call an error rate. So they'll take a sampling of them, and then whatever percentage of those are wrong, they'll assume that they're all wrong that way and assess their fines and penalties accordingly. So then the business is forced to try to reconcile that and prove what their actual exposure is. So it just creates a lot of burden and a lot of time. So exemption certificates are kind of a difficult thing to get right. And many businesses are just doing a poor job with it, not because they aren't capable, but because there's just so many other demands on your time than to make sure that this little piece is always right. And a lot of times they're getting created by salespeople or somebody who's not primarily focused on compliance. So another piece of sales tax compliance that can be complicated is jurisdiction. So if you think about what many businesses do is they'll use zip codes in order to determine what rate they should charge. And in this slide here, you can see an example where a zip code of 80111 is used. And you can see all the different regions with all the different rates associated with it. And the reason that doesn't line up like we want it to is that zip codes were created by the federal government in order to aid with the delivery of mail. They have nothing to do with sales tax. What they do is they get you into the general area, which is kind of makes it feel like you're getting close enough. But as you can see, there's so many different rates and there's so many different rules and boundaries that it will get you close, but it will often not be correct. So this can be a very complicating process. Product taxability, I don't know how much this will affect the folks on the line today. But again, it's the idea that not all products are taxed the same way. It's always kind of a fun one to look at, though, because if you see in Indiana on the bottom right hand, it says Indiana candy bars, taxable Snickers, not taxable Kit Kat and Twix. Not taxable is because there's flour, and in that state, they decide any product that's flour has flour in it as groceries and doesn't get taxed as a candy, whereas Snickers doesn't have flour and therefore it is taxable. And these rules can get very complicated, right? Because they're going to change over time and they're going to evolve over time, and they're just different in every state. So if everything you're selling is the same thing, you probably won't feel too much strain on this. But if you sell a lot of different SKUs, this can be very complicated. There's different tax treatments. The business I'm in, where it's software, software that used to be delivered on a CD was taxed different than software as a service, taxed different than software that's downloaded. There's all different ways and categories for the way software is delivered that determines whether it's taxable or not. So as a general rule, and this is the slide I meant, I apologize that it was out of order here. So the exempt sales, if you look at the maps, you can see the slides where the blue, the lighter blue, those are all states that include exempt sales in their economic nexus threshold. Now, there is a subset of those states that will exclude sales that are for resale, where some other ones say all exempt sales. Some will say only exempt sales if they are to churches, municipalities, governments, things like that, but not resale. So again, the burden is on the business to make sure they understand which state has which requirement and whether or not they're meeting that requirement. And then to add on to that, just below that, the other slide is showing how states are viewing services, which some states, a lot of the ones you see in dark blue there, the California example, we don't tax services, but many states do, and some of them also include that in the economic nexus requirements. So consumer use tax, a lot of what we've been talking about has been tax on the things that we sell. And consumer use tax is tax on the things that we buy. So when you make a purchase, perhaps you're buying from a company that doesn't have nexus where you are for whatever reason. So they ship you the product and they don't charge you the tax. If we're a consumer, we're probably just going to ignore that. Although technically speaking, a little fun fact, when you fill out your tax return at the end of the year, there's a little line to say for you to self-assess any purchases you made where you were not charged the tax. So if you personally buy something and you don't pay tax on it, you're supposed to go into your tax return and fill out that little form and say, yep, I actually bought this, I didn't pay tax, I'm including it in my tax return. You can probably guess how many people go to the lengths to do that. But it's the same for business. The difference is that the government's not going to make a ton of money coming after me because I owed $35 on the TV set I ordered online, but they can make a lot of money off of business that is making large purchases and not getting taxed for products for their whole business. So if you have things that were taxed either not at all or incorrectly, you want to reconcile that. If you have materials that you move from one place to another, so you actually buy them in one location, but then you use them in another facility, that could create some tax exposure. A great example I can think of from Avalara's perspective is we're headquartered in Washington State. We buy laptops, as you can imagine. We've got quite a few employees, and so we buy a lot of laptops and then we ship them out. And we have a lot of remote employees. We have a whole group of employees, a large group in Oregon. So Oregon doesn't have sales tax, Washington does. So if we order those laptops and then we ship them to Oregon, we should be able to get a credit back on the tax that we paid from that transaction. Those types of things. And if those on the call are dealing with consumer use tax, you probably understand how complicated it is and how frustrating it can be. And the challenge is that by and large, companies are just doing this in spreadsheets or manual entry and manual calculation. So this gives us the ability to help you and automate that process and capture more of the funds that you should have been saving on, and then also prevent losses. So a little bit about document management. I mentioned that earlier. When we think about exemption certificates, I shouldn't say a lot of companies, but some companies we encounter have put into place document management. And document management is used for a lot of facets of your business, not just exemptions, right? There's a lot of things you can keep in there like contracts and orders. And when you want to be able to retrieve those later, it can be an invaluable tool. But there's some specific things when it comes to exemption management where it falls short. Primarily, communicating with, we have the bullets here, but communicating with customers, setting them up to be completed and validating them. So when you look at a solution like Avalara, what we do is we give customers the ability, when they have a new customer onboarding, if they want to have an exemption certificate, they actually fill out a wizard online that gets all the data from the customer and pushes it into the system. And as long as that data is valid, the customer will get a no tax on their invoice. If it's not valid in any way, if it expires, if it's for a product different than what they signed up to get, then it would make the order taxable, which is ideal, because if the customer gets taxed, then they'll contact you, right? They'll say, hey, I got taxed, I shouldn't be, and we can validate the issue and find out. If they don't get taxed and they should have been, then the burden shifts to the business, right? Because the business owes the tax, they're just allowed to pass it to the customer. So it's important that there be a way to prevent that transaction from occurring if the tax wasn't collected and it should have been. I'm going to go ahead and click these through here. So this basically takes us through business-to-business e-commerce experience, kind of what you need from the seller's perspective and what you need from the buyer's perspective. So from the seller's perspective, you want to be able to collect documentation in order to validate that customer is exempt. You want to have quick access to the document. You want real-time automated checks, workflow to approve, et cetera. Decreasing rebuilds. You essentially want it to be a smooth, seamless experience for your customer, but you also want it to be completely compliant for you so that you've got all the validation that you need. And then kind of the same for the buyer, right? They want to be able to, they want it to be easy to buy from you. They want you to be easy to do business with. So they need access to these documents. They need to make sure that they can fill them out correctly and that they get the tax-free invoice that they're expecting. So why automate sales tax management? So the idea, but the whole reason Avalara exists has kind of been highlighted in the earlier slides, right? It's a complicated landscape that we operate within. And by using something like Avalara, you have accuracy, you have efficiency. We're cloud-based, so it's very easy for you to populate your invoices with tax. It's done through a quick web call through the integration that the folks at VAI have developed. Ideally, you want strong customer satisfaction because the tax rates are correct the first time and every time. It manages your risk and allows you to focus on growth. So one of the things that we point out is that if you have somebody who's spending a lot of time on sales tax management, like a big chunk of their day, the question is, what could that person be doing for your business to help grow and expand it, as opposed to just focus on compliance, right? Accounts receivables, looking for new products, looking for the financial impact of new products or new markets, et cetera. There's a lot of different things that people can do with their business that would help them grow their business and focus on generating more revenue than just focusing on trying to prevent errors and liabilities and audits and things of that nature. So just a quick overview of kind of what our suite of products looks like. People think of us for sales tax calculation. If somebody knows who we are, you say, what does Avalara do? They go, oh, they calculate sales tax. And that is true insofar as that's where our business was founded, and that is the core of everything, like of all of our software. But as you can see from the slide, we've added a lot of things over the years, some through acquisition, some through product development. But calculations is at our core. It connects to the S2K enterprise platform. And when you generate an invoice, it makes a quick call to us, and it takes all the information from your invoice. It takes what did you sell, who did you sell it to, where's it shipping, et cetera. It takes all that information, and in a sub-second, it delivers the correct rate and a result to the tax invoice. But beyond that, we manage exemption return, filing sales tax returns. Documents refers to the exemption certificates and the management of those. We can help you when customers find that they have to be in a lot more states and jurisdictions than they thought. We can help them with the registration process. We can handle the paying of the states for the various returns. And then we can also offer a lot of reporting to help you figure out, where your nexus exposure is coming from, where you're maybe starting to reach additional exposure, things of that nature. We also have acquired a company in the last 2 years or so called TTR. They're a tax research company. And so we already had that as part of our business, but they built it out into kind of more of a deliverable. So in addition to having our in addition to having our software, you can actually subscribe to this tax content, which helps companies make tax decisions. It gives you, rulings and legislative proofs as far as, when you're setting up your tax profile so that you can know that you're following all the different laws and regulations, and it gives you the documentation to support those things. and also global and e-invoicing, which is a big thing we're starting to see for those that are doing business internationally, where they're requiring companies to do e-invoicing over there. So there's a whole breadth of solutions. So if there's any piece of this that you think might be of interest to you, I'm happy to chat with you and get you connected with one of our sales executives to help you explore what we do and whether it would potentially be a good fit for your business. I have up on the slide, I have my email address and phone number. If you want to reach out to me directly, I'd be happy to chat with you. And like I said, we can get you in touch with somebody who can, help you explore what we do and see if it might be a good fit for you. Otherwise, just love to thank everybody for taking the time today and for VAI for hosting us. And hope everybody has a great day.